Hi, Adam Khoo here, and in this video I'm going to show you the 7 powerful facts about the stock market that's guaranteed to make you rich. And I know you're listening to this because you know that the only way to build your wealth is to invest your money, is to get your money to make you money over time every single day. And there's no way you can become rich by getting a paycheck or just by putting your savings in a bank. And I know there are some people who say, Adam, I don't need to be rich. I just want to live a comfortable life to retire one day. And I'm here to tell you that even if you want to retire one day just comfortably without working to the end of your days, then you have to invest. Because most people who don't invest will end up broke simply because of inflation eating away their savings. So let's look at some simple facts. First question is, how much do you need to be financially free? To retire one day just comfortably, not even becoming rich? Let's do some simple math. So let's assume you are now 35 years old, and I'm just taking a median age right at the center. If you're older, you have to recalculate this if you're younger. And assuming you like to retire, by 60 years old at least, to have some more good years to enjoy yourself while you can still do it, right? And let's assume that you earn $5,000 a month. Again, that's a very average income in most societies. So that's making 60 grand a year. Okay, so let's assume when you retire, you have got 25 to 30 more years to live. So you need your money to last you for 25 to 30 years. With medical advancement, living to 85 to 90 is going to be pretty possible. Okay, now how much do you need once you retire? Okay, now you need roughly at least 70% of your current income to cover your expenses once you retire. All right, I mean, you save some money there, you don't have to commute to work, but you still need 70% of that for your living expenses. Okay, so again, how much do you make? If you make 60 grand a year, you need at least 70% of that, right, to cover your expenses. And you need that a year. So if you multiply that by 30 years till you die, you need $1.2 million just to live comfortably at your current lifestyle. $1.2 million, okay? Now, this is based on today's money, not based on future dollars in 20, 30 years. That's based on inflation. Now, think about it. 20 years ago, a movie ticket in my country cost $4. Today, that movie ticket costs $12. So, which means that because of inflation, in 30 years, things are going to be 2 to 3 times more expensive than they are today. So, to maintain the current lifestyle today, you will need probably about 2 to 3 times that money, which means if you take 1.2 million times 2.5 because of inflation, you actually need $2.5 billion just to retire at 60 years old to maintain a simple, comfortable lifestyle. When most people look at it, they say, Adam, there's no way. How can I ever save $2.5 billion? It's impossible. And that's what most people think. And that's why majority of people end up never being able to retire. They work to their death. And even if they do retire, they live very miserably. They end up broke. Okay? Now the good news is, I'm here to tell you this, that even if you start investing now with the right strategies, with some simple ideas I can give you, you will be able to end up with at least $1 or $2 or $3 million by the time you retire. I can guarantee you that with some simple ideas. So if you're ready, I'm going to share with you some of these simple ideas. Now, first of all, understand that you can build $1 to $3 million if you learn how to compound your money over time. Because investing gives you the power of compounding. That means it allows small money to grow into huge amounts of money over time if you do it consistently. All right, so let's take a look at some simple math again. Yeah, so let's imagine, and I wouldn't say imagine, I'd like you to commit to do this if you want to ever be financially free. I'd like you to commit to save at least 15% of your income. And this includes your CPF money or your 401k, whether in the US or in Singapore, your EPF in Malaysia, yeah, that includes that, okay? So, if you're earning $60,000 a year and you save 15% of your money, you're saving $9,000 a year. And that's all you need to end up with $1, $2, $3 million if you invest now. So let's assume that you can grow your money at 11% a year. And I'm going to show you in this video how anyone can grow their money at least 11% a year easily without much effort. I can guarantee you that. Just stay to the end of the video and you'll learn exactly how to do that. Okay? So again, if you start at the age of 35 over here and you save $9,000, okay, every year till you're 60 years old, so that's about 25 years, right? Now, if you don't invest it, if you just put it in a bank with hardly any interest or zero interest, you end up with $234,000 at the age of 60 years old without the power of compounding. And again, $200,000 not gonna last you diddly squat for long because you need at least $2 million. Remember that? Okay. Now, if you can grow your money at 11% a year, again, which I say is the minimum that I'm going to show you how to do, you end up with $1.27 million. Okay, 1.27 million. At least you end up with $1 million, right? But I showed you earlier on that $1 million may not even be enough based on inflation, right? So if you can grow your money at 15% a year, which I'm going to show you how to do again at the end of this video, you end up with $2.5 million, which is just nice. Oh, you just got that, just enough to live comfortably till you die. Okay, but if you say, I don't just want to live comfortably, I would like to get a bit of more than being comfortable. I like to be a bit wealthy, right? Then you need to grow your money by at least 20% a year or more. Right now, that takes a bit more advanced investing techniques, a bit of advanced trading techniques, which I'll show you in my future courses, in my professional courses, at least 20%. In fact, many of my students are getting 30 to 50% a year compounded returns, but they put in more effort picking the right kind of stocks. To do that, you have to put a bit more research and effort. And if you do that, you grow your money to $6 million. So notice that in all the scenarios, whether you end up with $234,000, $1 million, $2 million, or $6 million, in all these scenarios, guess what? You're saving the same amount of money. You're saving $9,000 a year. So why is the result so different from $200,000 to $6 million? Because of the power of compound returns. So the first lesson you have to learn is that if you want to end up wealthy, don't just focus on how much you save. Focus on how do you get the highest return from your investment. And to do that, you need new ideas, you need new skills. So let me show you now, again, the 7 powerful facts about the stock market that's going to allow you to compound your wealth. Now, many people, when they think of the word investing, especially the stock market, they get a bit concerned because they say, Adam, I've heard that the stock market is risky, that it's volatile, that it can drop in value, all right? And that's the common belief that people have. And I can tell you that that's true. In the short term, the stock market is volatile, is risky, is unpredictable. And if you don't know what you're doing, yes, you can end up losing money, which most people do. But if you know what you're doing and you take a long-term view, I will show you through these 7 powerful facts that the stock market, in fact, is very predictable. The stock market is extremely safe. In fact, it's the safest place you can ever put your money. I'm not kidding. Because if you don't invest your money and you put it under your mattress, in 20 to 30 years, because of inflation, things are going to be 3 times more expensive. A movie ticket at $12 today is going to be $30 to $40 in 20 to 30 years, which means if you don't invest your money, that's the most risky thing you can do with your money. Because it means your money is going to be worth 1/3 or 2/3 less in 20 years. That means you're going to lose 65% of your wealth by not doing anything. But if you invest your money and allow it to grow, that's the safest thing you can do for your family and for yourself. Again, with 7 powerful facts, you're going to learn that the stock market is the safest place to put your money. It's going to be really predictable. So if you're ready to... Right, fact number 1, stocks are the best builder of wealth. If you're wondering where your money can multiply the fastest, is it real estate? Is it bonds? Is it commodities? Is it the stock market? I can tell you, without a doubt, it is the stock market. Because when you buy stocks, what are you buying? You're buying a part ownership of a business. You're buying a company. You're becoming a business owner, right? And businesses grow in value much faster than any other asset. And you can see from this chart, for example, in the US, in the last 30 years, US stocks, from if you had invested $10,000 in the 1980s, it would have grown to $277,000 over the last 30 years. And if you compare that to the overall real estate market in the US, you can see that same $10,000 would have grown to $58,000. So there's a huge difference between the stock market and the property market. Now, this $58,000 based on nationwide homes. So if you take a rich county, for example, Orange County, which is in California, of course, real estate would appreciate a lot faster than in other parts of the US. So if you take Orange County, which is OC Homes, you can see that $10,000 grows to $126,000, which is still a lot lower than investing in businesses. That is why one of the richest men in the world, Warren Buffett, who grew his money purely from the stock market to $65 billion, he doesn't invest in real estate. The only real estate is his own home, but he puts everything in the stock market because he knows that the stocks are the best way to build your wealth. Now, some people would ask, hey, does this apply to Asia as well? Because I know in Asia, real estate is a great investment. I agree, it is a great investment, but stocks, again, outperform real estate even in Asia. So let's take one of the most Asian markets, which is Hong Kong. So Hong Kong represents China, one of the biggest Asian markets in the world. Again, if you look at the last 30 years, you can see that the Hong Kong stock market, which is the Hang Seng Index, which is the one in black, has outperformed the Hong Kong housing prices, which is in red. Right? So same goes even in Asia. Stock markets outperform all other investments you can put your money in. But I always do recommend that you have a diversified portfolio. Right? Put some money in real estate as well, some money in stock markets, some money in bonds if you want to. But what I'm saying is that the majority of your wealth would come from the stock market. Here's another chart. Now you can take a look at if you ever want to beat inflation. So inflation is about 2 to 3% a year. Okay, so in most banks around the world, you can't beat inflation. I come from Singapore, and our bank deposit rate is a miserable 0.2%. Okay, so every year that my money's in a bank, I'm actually losing my wealth. So I basically invest almost everything I have into the stock market. Gold, in the long run, only gives you 3.84% compounded in the last 30 years. So again, gold just beats inflation, but that's just about it. Okay, bonds return about 6.4%. Real estate returns about 6.7%. And this is based on Singapore real estate, which is again one of the most expensive properties in the world, and it grows about 6.7% a year, with rental income included. So rental income plus capital appreciation. Now, if you compare all these investments to the stock market, again, the stock market gives the highest returns. And this is based on the last 30 years. You can see that the US stock market, which is represented by the S&P 500. Now, this is really important. The S&P 500 is an index that represents all the stocks in the stock market. And it's made of the 500 biggest companies in the US market. So in the last 30 years, the S&P 500 has returned 11.14% compounded annual return, which means the return on average in a year is about 11.14%. Now, this is based on dividends being reinvested as well. Now, how does that compare to other markets? Well, in the Singapore stock market where I'm residing, in the last 30 years, Singapore has returned 7.79%. Right? Hong Kong has returned 11.37%. The UK, 9%, and Australia, 9%. And again, this is based on the index of that market. So you can see that in the last 30 years, the two fastest growing stock markets, or the best performing, has been the US market as well as the Hong Kong markets. Okay, so that's where I put my money in, the US markets and the Hong Kong markets. Now recall from our calculation earlier that we have to get at least an 11% return a year on average in order to achieve at least $1 million upon retirement. So that tells you that to get at least 11% a year in the stock market, you have to invest in either the US market or the Hong Kong markets to get an 11% return. This is based on the last 30 years of history. Okay, you can't get 11% on any other investment. So that's fact number one. Fact number two, the stock market always goes up in the long run. Like I said, in the short run, the stock market seems volatile and unpredictable. It's kind of like a roller coaster. Every time it goes up, it will come down. It goes down, it goes up, right? But in the long run, it's extremely predictable. It's extremely safe because it always goes up in the long run. Now, over here, you can see the chart of the US stock market, again, represented by the S&P 500, the 500 biggest companies that represent the entire range of companies. That's the index, okay? And this is over the last 72 years. So what do you notice in the last 72 years, right? 72 years ago, the index was at 13 points in 1945, okay, at this point of time. And today, the S&P 500 index in 2018 is at 2,670 points. So over the last 72 years, stock prices have grown by 205 times. 205 times, right? That's a 20,000% return on your wealth, right? Just by investing in the stock market. So notice something interesting. Again, in the short term, we get spooked out by all kinds of news, right? There's a recession coming, the stock market crash, the dot-com crash, the financial crisis, But again, if you look at history, notice that all these crashes seem very insignificant and temporary when you take the long-term view. In fact, over here you can see this was the dot-com crash. The dot-com crash. This was the great financial crisis, the subprime mortgage crisis. This was the oil crisis back in 1974, 1975. This was Black Monday, the crash of 87, right? So during that time, again, it seemed really scary. It seemed like the world was coming to an end, but looking back, you can see that these were very good opportunities to enter the market at lower prices before the market went higher. And the same thing will happen in the future. So again, the stock market will always go up in the long run. So let's just take a look at the last 30 years of the stock market, again, based on the S&P 500 index. So in the last 30 years, you can see that the US markets have achieved a compounded annual return of 11.14%. This is based on an 8% compounded annual growth of the price appreciation with a 3% dividend yield. So that gives you 11% in total price appreciation plus dividend yield, which means the company's paying dividends, all right? So if you bought the S&P 500 30 years ago, over here, when it was about 280 points, and now it's about 2,600 points, guess what? Your total return will be over 1,000% in the last 30 years. So the fact is that in the short run, okay, stock markets again are like roller coasters. Every time it goes up, it goes down. It goes up, it goes down. It goes up, it goes down. But every time it goes down, you'll go higher. It goes down, it goes higher. So in other words, you always win if you hold long enough. You will always make money if you hold the stocks long enough because it always goes up. Now the question is this, why does the stock market always go up? Why? There must be a logical reason, right? And there are 4 reasons why the stock market will always go up. Reason number 1 is because of inflation. So in 20 years, companies would price their products higher, right? A Big Mac would cost more in 20 years than it would today. So when a company prices the products higher, what happens? Sales revenue is higher, profits are higher, earnings per share is higher, and share price goes higher. So inflation guarantees higher prices. That's number 1. Number 2, population growth. So in 10 to 20 years, there'll be more people in the world. So more people will buy more products. So companies have to keep growing to supply a bigger demand in the world. So companies keep growing, their share price keeps going up. Number 3 is because the 30 companies, sorry, not 30, the 500 companies in the index are not always the same 500 companies. They change all the time. The moment a company is no longer a market leader, what happens? It's kicked out of the index and replaced by a better company. So for example, if you look at, have you heard of AIG, right? Citigroup, General Motors. These companies used to be in the Dow Jones Index, right, which is another one of the index, and the S&P 500. But now they have been kicked out of the index. Why? Because they are no longer good companies. And they were replaced by better companies like Apple and Visa and Nike and Goldman Sachs. So in other words, the 500 companies in the index are always the best 500 companies in the index. And that's why it is engineered to always go up in the long run, because the lousy companies get dropped out. Does this make sense? The fourth reason why the stock market will always go up is because of technology, because of productivity. Over time, because of technology, businesses get more and more efficient. They lower costs, they increase prices, and they keep going up in the long run. Now, let me make a caveat here. When I say that you always win if you hold long enough, stock prices will always go up, right? That only applies to the index. That only applies to the index and not an individual company that you invest in, because a company you buy could go to zero. Like Enron was a business that went bust. WorldCom went bust, right? A Nokia that used to be a great stock dropped 90%, right? You know, so an individual company can drop and never come back. I'm not talking about individual company. I'm talking about the index as a whole will always go up. So that's fact number 2. Let's move on to fact number 3. And fact number 3 is that the stock market makes annual gains 75% of the time. If you take a look at the last 67 years, you notice something interesting. Out of the last 67 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 years ended with a loss. And 50 years ended with a gain. So that tells you that 50 out of 67 is 75%. And 17 out of 67 is 25%. So in any given year, when you invest in the stock market with just a 1-year time horizon, the chance of you ending up with a gain is 75%. So that's better than any casino you can ever go to, right? If you go to a casino, you put your money on black or red, odd or even, your best odds are 50-50. But whenever you put your money in the stock market, you've got a 75% chance of making money on any given year. But like I told you this, if you take a long-term view, it's 100% you're going to make money. But in the short term, it's just 75% chance of making money. So moving on to fact number 4. Now we said that stock prices always go up. The index always goes up, right? Right. But here's the thing. Stock prices don't go up in a straight line. They are not linear, right? They are cyclical. They move in cycles. So fact number 4, stock prices move in cycles, and we call them trends. Just like the weather moves in cycles. In most temperate countries, you have got winter and summer, right? Now, you know that you enjoy summer, you love summer, but you know that winter will come, right? So you expect winter to come. And when winter comes, you can enjoy winter as well. And winter won't last forever, right? After winter, you have got summer. Same thing in the stock market. Stock markets go through these summer and winter cycles. So you got to expect it, enjoy it, and benefit from it. So basically, stock prices move in 2 major cycles. First is what we call the bull market cycle. So a bull market is also known as an uptrend phase. So during a bull market, what happens is that stock prices go up and down, all right? They go down as well. But guess what? Every time the stock price goes down over here, let me just draw it over here. Every time the price goes down, guess what? It makes a higher high than the previous high. It goes down, again makes a higher high than the previous high. Goes down, makes a higher high than the previous high. Right? So in other words, in a bull market, the stock price makes higher highs. Now at the same time, every time the price goes down, over here we call this a correction or a dip, it makes a higher low than the previous low. Can you see that? It goes down, it makes a higher low than the previous low. Higher low than the previous low. So again, on a bull market, we also call this an uptrend, right? Known as an uptrend. Prices make higher highs and higher lows. So overall, the trend is that prices go higher. So when does this happen? This happens during economic growth and optimism. People are optimistic about the market, so every time it dips, it goes higher, it dips, it goes higher. So these are known as bull markets. There we go, bull market and bull markets. So that's known as summer, if you would like to call it summer, right? Now, every so often, we have got bear markets. Bear markets are like winter, okay? So these are bear markets, okay? So bear markets are periods where prices go up and down as well. But in bear markets, if you take a look, every time the price goes up, right? Let me just use a different color here. Every time the price goes up, it goes lower. It goes up, it goes lower. So in a bear market, prices make lower highs, okay? Lower highs. And they make lower lows. There we go, lower highs and lower lows. And over here you can see lower highs, lower highs, lower highs, lower lows, and so on and so forth. So every time the price goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower. Right? So this is also known as a downtrend. Now, bear markets happen during recessions, crisis, and the overall mood is pessimism. People are pessimistic, right? So every time the price goes up a bit, it goes lower. It goes up a bit, it goes lower. So these are known as bear markets. So let's take a look at the S&P 500 over the last 30 years, and let's take a look. Can you identify, again, the bull and bear markets in this chart? Okay, so let's take our drawing tool, and first of all, you can see that this over here is a bull market. All right, there you go. That's a bull market. That's a bull market. That is a huge bull market, right? So you can see currently now we are in a bull market, and the bull market started in 2009. Now it's about 2018, so the bull market has lasted for 9 years. The current bull market is 9 years. There we go. All right. This bull market, this lasted for about 6 years. Okay. And this bull market lasted for about 6 years as well. All right. So you never know how long a bull market can last. It could last for 9 years, 10 years, 6 years, 12 years, right? And in the last 30 years, we had 2 bear markets, right? So that was a bear market over there. And this bear market lasted for 2 years. And this bear market lasted for, let's take a look, 2 years as well. There we go. So these are the bull markets and the bear markets. So this concludes part 1 of this video. So do look out for part 2, where I'll be going through the next 3 facts that are going to be mind-blowing. The next 3 facts, I'm going to show you exactly when you buy, when you sell to maximize your returns. So you're going to end up with at least $1, $2, or even $6 million in your retirement account. So before we go further, remember to subscribe to this channel to get more videos. If you'd like to find out about my professional stock and forex trading courses, you can go to wealthacademyglobal.com, where we run our live courses in Asia, or scoot on to piranhaprofits.com, where we have our online professional trading courses. This is Adam Khoo signing off, and I'll see you in part 2 of this video. May the markets be with you.